Hello, everybody. Welcome. This is Wiley's Solution Walkthrough Accounting Tools for Business Decision Making. This is the 8th edition, exercise 20-3. Textbook authors are Paul Kimmel, not Paul Mitchell, the hairstylist, but Jerry Weingett and Jill Mitchell. The question used in the presentation is copyright 2022 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of myself, Bennett Tchaikovsky, not the authors of the textbook or Wiley. Okay, so let's go through and now take a look at exercise 20-3. So we're being asked to prepare an incremental analysis in terms of like, well, what happens if you accept the business? What happens if you don't? I generally, for myself personally, what I want to do first is to analyze the existing business, see where it is, and then analyze if we accepted the new business and to see where that is. If it's more profitable than our existing business, we may want to go through with it. If not, and just remember, like when it comes to accepting additional business, like salespeople, they want to just make money on the commission. So, right, so they're going to be saying, oh, this sounds like a great idea. Let's go ahead and do it. But you want to be the person who's saying, you don't want to be saying no, 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 but you want to say, well, like, let's go through and take a look at it. So let's take a look. So Moonbeam manufactures toasters. For the first 8 months of 2025, the company reported the following operating results while operating at 75% capacity. So here we go. So cost of goods sold is 70% variable and 30% fixed. Operating expenses were 80% variable and 20% fixed. So let's go ahead and now kind of say to ourselves, like, okay, so our sales are 350,000 units. Okay. My total amount here is 4,375,000. So units per unit and my total. So my total per unit is going to be roughly, so I'm selling these for roughly $12.50 per unit. Let's now go to cost of goods sold. Okay, so what it tells us is that our cost of goods sold is 70% variant. I'm going to put this over here a little bit. Okay, so my cost of goods sold is right over here. Is going to be, we'll put it as cost of goods sold, variable, cost of goods sold, fixed. My fixed amount of my cost of goods sold is, it tells me right over here that the variable amount of cost of goods sold was 70% of 2.6 million. Okay, so this is important because if this is variable, then this is going to basically be varying with production. So my rate per unit on the cost of goods sold is going to be roughly about $5.20 per unit. This part over here is fixed. So our gross profit, or so our total cost of goods sold, our total cost of goods sold over here is 2.6 million. So our gross profit is not changing. We're just kind of reformatting what we're doing here. So for my operating expenses, right, it tells us over here that 80% are variable and 20% are fixed. So if my operating expenses are 840,000, this is going to be, so over here, this is 840,000 times 0.8, right? And then over here, this is going to be 840,000 times 0.2. Okay, so this over here, again, because we're making 350,000 units, this is going to be at roughly $1.92 per unit. So our total operating expenses are going to be at over here at 840,000. So our net income is going to be our gross profit minus our operating expenses are 935. So our net margin is going to be our net income divided by our sales. Okay, so over here, net income, dividing this by our sales, what we're going to end up with over here is we're going to end up with about 21%. So right now, if we make a sale, we're roughly making about, during the first 8 months, we're making about 21%. Okay. So this is all of our existing business, right? So when you get these types of problems, my thing for you to do would be is that, like, let's understand our existing, right? What does our existing look like over here? And now let's go through and take a look at the new business. So in September, Moonbeam receives a special order for 15,000 toasters at $760 each from Luna Company of Ciudad Juarez. Acceptance of the order would result in an additional 3,000 shipping costs, but no increase in fixed costs. Okay, so if we accept these units, what are we looking at in terms of making? Well, the new sales in terms of units are going to be 15,000. We're going to be selling those for $7.60. So this is going to be over here. This is going to be a total of 114,000. Okay. So we've got 114,000. So, and it also tells us over here, so if we go through and accept it, what else does this look like? Well, our cost of goods sold variable at 15,000 units, this is going to be at $5.20 per unit, right? Because that's going to be the variable amount over here. So over here, I'm going to multiply this through my cost of goods sold fixed. This is going to be 0. So my total cost of goods sold is basically going to be over here at 78,000. Now, for my gross profit, it's going to be $36,000. But I still now have to deal with my operating expense for variable. So this is going to be 15,000 at $1.92. So when I multiply this through, I've got 28,800. Now, in addition to this, I'm going to have to spend another $3,000 to ship it, right? So my shipping costs is going to be over here, and I'll move this down just a little bit. So my operating expense fixed is going to be 0 because they're fixed costs. This is going to be 3,000. So my total operating expenses are going to be right over here, 28,800 plus 3,000. Okay, so my net income is going to be 36,000 minus 31,800 or $4,200. Let's go ahead and take a look at the same thing. So let's take a look at our net margin. Our net margin is going to be our net income divided by our sales. So this is going to be 4,200 divided by 114,000. And when we look at this over here, this is about 3%. Now, I'm guessing, right? Would you want to take this kind of like, have like this kind of a potential margin, and what you don't know is, can we go through and accept this? And should we accept it? And I would say absolutely not. Why not? Because you're making 21.3% like a net margin on your existing business. Your new business is only coming in at 3. This is too much of a discount. But I have a feeling that when we look at your textbook solutions, and we're going to do that in just a moment, because it's like the big reveal, is that they're going to say, do it. So let's see what they do. And let's go ahead and find this right over here. Okay. So we're on exercise 20-3. Okay. So, we got the right number. Okay. So, yeah, they should accept it because it increases by 4,200, but it's like, dude, you've got very, very little room for error. And remember, the people that are doing the selling, they're going to want to basically go through and do whatever they're going to do. So they're looking at this like, and again, all these textbooks do this, and it just drives me bananas. I just don't get it. I don't like this whole incremental analysis thing. I mean, I just don't look at it like that. It's like, okay, you've got existing business here. Oh, here's the new business. Well, this new business, right, has a really bad margin, right? This is a 3.68% versus 21. Not only that, when you sell something at, you're going again, you're normally selling something at $12.50. You're giving your customer right over here like a $4.90, discount, or almost a 40% discount. I mean, look, if you tell someone like, hey, if you order a bunch of stuff from us, you call it like a volume discount or something like that. But again, what you're risking is that when you give this kind of a discount, you're basically signaling to your customers that you can basically sell it at this rate all day. And that's why I would say absolutely not. So again, this is where my failure of incremental analysis is, because I just don't believe it. I like looking at it this way. And if you have instructors, I want to encourage you to kind of, when you look at this new additional business, this is the way that I look at it. It's clearly different than the solution that the book is giving, but hey, we're all entitled to our own opinions, which is great. Okay, so I want to thank the bus driver, thank Wiley for allowing me to be here today. Again, I really appreciate them sharing. I'm not sure if I'm going to do it anymore, but I really appreciate them allowing me to go through and to make these videos. Have a great rest of your day, and I look forward to seeing you on future videos. Thank you so much.